Today, we will be discussing the rise of private credit in the U.S. and exploring whether it could be a potential threat to the economy. My name is Joseph Foy, and I'm joined by Ali Abdul Sader, Jackie Fan, Nicholas Battaglia, and Nicholas Chinque. Let's start by covering what private credit is. Private credit, also called private debt, refers to loans and other forms of debt financing that are provided by non-bank lenders rather than through traditional banks or public markets. Examples of these lenders are investment funds, private equity firms, or institutional investors. In simple terms, private credit is money lent directly to companies without going through the public bond market. Instead of issuing bonds that trade openly, a borrower receives financing from a private lender through a negotiated agreement. There are a few key characteristics that define this asset class. First, it's non-bank lending, meaning the funds come from private sources rather than commercial banks. Second, these loans are typically illiquid since they aren't traded on public exchanges. Third, the terms are customized, so interest rates, repayment schedules, and covenants are all negotiated case by case. Because these loans are riskier and less liquid, they tend to offer higher returns to their investors. Finally, they have limited transparency, as the deals are private and not subject to the same public disclosure requirements as traditional debt markets. Private credit comes in several forms. The most common is direct lending. This involves loans made directly to mid-sized companies, often to finance acquisitions or expansion. Then there's mezzanine debt. This is a hybrid of debt and equity that allows lenders to convert their holdings into ownership if the borrower defaults. Distressed debt focuses on financing or investing in struggling companies looking to restructure. Venture debt is targeted towards startups and early-stage firms, complementing venture capital. A real asset credit involves lending against tangible assets like real estate or infrastructure. The growth of private credit can largely be traced back to the 2008 financial crisis. After the crisis, new regulations like Basel III made it harder for banks to lend as freely as before. This created a funding gap, and institutional investors, such as pension funds and insurance companies, stepped in to fill it. Today, private credit has become one of the fastest growing areas of global finance, with total assets exceeding $1.7 trillion worldwide as of 2025.
Now, let's take a look at who the major players are in the private credit market. Today, private credit is dominated by large global asset managers that have built massive lending platforms outside of traditional banks. The top 5 firms collectively manage over $1.5 trillion in credit assets. According to ChatGPT, this is the order of the 5 largest firms. First, we have Apollo Global Management based in New York City, the largest player with around $450 billion in credit assets. Apollo focuses on flexible and customized loans, providing financing to companies of all sizes across industries. Second is Blackstone, also headquartered in New York City, managing well over $300 billion through its credit and insurance division. Blackstone specializes in large-scale direct lending and corporate debt financing around the world. Third, Ares Management, headquartered in Los Angeles, oversees around $250 to $335 billion in credit assets. Ares is a leader in direct lending to mid-sized companies, offering long-term loans that help businesses grow without relying on banks. Fourth, KKR & Co., based in New York City, manages roughly $242 billion in credit. Their strategy combines direct loans and asset-based finance, serving both mid-sized and large corporate borrowers. And fifth is the Carlyle Group, headquartered in Washington, D.C., with around $190 to $200 billion in credit. Carlyle focuses on direct lending and special situation financing, such as infrastructure, real estate, and growth projects. These approximate asset evaluations are based on data reported as of March 31st, 2025. Together, these firms play a central role in shaping global private credit, providing essential funding to businesses while offering investors attractive, higher yield opportunities outside traditional banking channels.
So what are the main benefits of private credit? First, for businesses, it fills a major gap left by traditional banks, especially after the 2008 financial crisis. Private credit gives small and mid-sized companies access to funding that's more flexible and faster to secure. Borrowers can negotiate loan terms that fit their needs instead of dealing with strict bank requirements. For investors, private credit offers high returns than public bonds and helps diversify portfolios. Many loans have floating rates too, so investors are better protected when interest rates rise. And finally, on a broader scale, private credit supports job creation and business growth, making the economy more resilient by spreading lending beyond big banks. In short, private credit is a win-win: flexible funding for businesses, strong returns for investors, and overall support for the economic growth. Next, let's look at the risks that comes with this rapid rise in private credit.
Next, I'm going to be talking about the risks. First one would be lack of transparency. There's a major transparency problem. Private credit deals don't go through public markets, and they're not required to report details the way public bonds or bank loans are. That means regulators, investors, and even other lenders can't easily assess how risky the loans are or how much exposure funds really have. This makes the system harder to monitor and react to in a crisis. The second one would be illiquidity. Second, these loans are highly illiquid. They're not traded on public markets, so if a private credit fund faces a rush of redemptions or needs cash quickly, it can't just sell the loans easily. In a stressed market, this illiquidity could cause a freeze in credit or even force funds to sell at a fire sale prices, spreading instability. The third one is hidden leverage. Many private credit funds borrow money to increase their lending, a practice called leverage. That boosts returns when times are good, but it also magnifies losses if borrowers start to default. The problem is that the amount of leverage these funds use isn't always clear, which adds to systemic risk. Next is the rise of what's called covenant-light loans. These are loans with fewer protections for the lender. For example, no early warning triggers if the borrower's financial conditions worsen. This becomes popular to win businesses, but it makes it harder for lenders to step in early when companies are in trouble, which could mean bigger losses down the line. Fifth is regulatory blind spot. A big issue is that private credit operates in a kind of regulatory gray zone. Unlike banks, private credit lenders aren't subject to strict capital requirements or regular oversight. That's why this space is often called shadow banking. Without proper regulation, risk can quietly build up and catch a system off guard. And lastly is systemic risk in a downturn. Many private credit loans go to highly leveraged companies, especially in private equity portfolios. If economic conditions worsen and defaults rise, the losses could spread beyond private lenders, hitting pensions, insurers, and other investors who've poured money down into the sector. This creates a potential domino effect across the financial system. Bottom line, private credit helps companies access funding, but if there's a shock to the system, its hidden risk could surface quickly and spill into the wider economy.
So what is the regulatory framework? In the U.S., there isn't one single private credit regulator. The SEC oversees fund managers, where they must register and report on Form PF, which was recently expanded to include more details on assets, leverage, and investor redemptions. The Fed, OCC, and FDIC care about how much exposure banks have to private credit funds, since many funds borrow from banks. They propose new reporting rules to see those connections. BDCs, which are public versions of private credit funds, are regulated under the Investment Company Act of 1940 with leverage limits and required SEC filings. And finally, international groups like the SMB, IMF, and BIS coordinate global standards, encouraging better data collection and liquidity risk tools so the non-banks don't cause hidden system stress.